Russell here, and the Bank of Canada just shocked the country with the largest increase in interest rates since 1998. Now, this is going to have a big impact on Canadians, as well as one of the Bank of Canada's largest concerns, which is a wage spiral. But not a spiral downward, no, a spiral upward in wages that the average Canadian makes. So in today's video, we're going to go over exactly what the Bank of Canada said and what it means for you in terms of your expenses, maybe your mortgage, your investments, and we're going to go over why the Bank of Canada thinks that wage prices going up dramatically is actually a bad thing. So to start, you probably already know that inflation is higher than it has been in decades, and this is exactly what the Bank of Canada is fighting against here. Now, typically the Bank of Canada would either raise or lower interest rates by around 0.25% or a quarter percentage each time there's a monetary policy report, which is what we just got. This time it was a full 1 percentage point raise, the fastest raise again since 1998. And this hyper-aggressive rate hike is what's leading many economists to say that the Bank of Canada has gone nuclear here. And we're going to explain exactly what this means for you, but let's listen in on Tiff Macklem, who is the governor of the Bank of Canada, as he explains just how dire the situation is.
An increase of this magnitude in one meeting is very unusual. It reflects very unusual economic circumstances. Inflation is nearly 8%, a level not seen in nearly 40 years. I want to explain to Canadians why we took this decision. Inflation is too high, and more people are getting more worried that high inflation is here to stay. We cannot let that happen. Restoring price stability, low, stable, and predictable inflation is paramount. The Canadian economy is overheated. There are shortages of workers and of many goods and services. Demand needs to slow so supply can catch up and price pressures ease.
So Tiff Macklem is saying, hey, here at the Bank of Canada, we're worried about inflation, yes, but what we're more worried about is inflation expectations, what you, the average Canadian, think is going to happen to inflation in the future. Because believe it or not, what you believe will happen can actually happen just because you believe it. If more and more people think that inflation will continue to go higher in the future, that incentivizes people to spend their money right now while prices are lower than they will be in the future. So everyone goes out and spends all this money, buys their goods now instead of tomorrow, because tomorrow it'll be more expensive. But as a result, it's kind of a self-fulfilling prophecy, right? People think that prices are going to be higher tomorrow, so they go out and spend all their money, and that adds more demand, and there's the same amount of supply, so prices go up, making inflation continue even further past the causes that are causing it right now. Well, of course, the printing of money that happened throughout the pandemic, but along with the war in Ukraine, along with other supply chain issues. So the Bank of Canada wants you to believe that there's not going to be as much inflation in the future, and that's one of the reasons they're doing this interest rate hike of 1%. Now we can see here what the Bank of Canada has sort of projected into the future to be what the inflation rates are. Let me zoom in here, make it a little bit bigger for you. So this is an interesting chart because the white line shows where inflation actually is and where it has been over time. Each of these different colors sort of leading down has been a different prediction by the Bank of Canada about where inflation will be in the future. Around this time, halfway through 2021, they projected that, well, by now, we'd be around this point, around 2.5% inflation. Clearly, we're not. We're at around 7.7. But it's interesting here because their credibility gets a little bit obscured here because you can see every single different time that they've had a chance to sort of project where inflation will be in the future, well, it's not been entirely accurate. And now they've changed their inflation expectations one more time. Again, partially saying, hey, this is what we think will happen, but also kind of trying to convince you that this is what's going to happen so you don't go out and spend all your money now, making inflation worse. They said in their monetary policy report right now that this is their new expectation for inflation. They say that by the end of 2023, we're going to see 3% inflation. So it would look something like this. This is what they're expecting. And they say that we're not going to see inflation all the way back down at where they want it to be, 2%, until 2024. So this is a change because they said previously, hey, we're going to expect it. End of 2023, we're going to be at 2.5% inflation, maybe even 2%. He also said that the Canadian economy is overheated and that we have far too many job vacancies, too many jobs available as a result of very, very high demand, people needing to buy goods and services. And this is why they think that raising these rates will have this effect. And this is a chart that I made in a previous video, but I think it gets the point across here. As they're raising rates, this is what they're doing, right? Their largest rate hike. They hope that inflation will go down because they're making people feel poorer. Less people are going to spend in the economy. Jobs and employment should go down as a result of this because businesses have less demand for their products, meaning they can hire less people. And the same with real estate, stocks, and crypto. When rates go up, it makes it more expensive to borrow money, and including borrowing money to invest. So all of these tend to go down as well. And of course, if you're interested in potentially picking up some deals on stocks and crypto while markets are down, especially if you're dollar cost averaging in over the long term, make sure to check out the link in the description to Wealthsimple Trade and Wealthsimple Crypto, where you can get $50 for free just for signing up. You get commission-free trades when you're trading stocks with Wealthsimple. Great platform, so check it out. Link in the description. Now, there's a particular reason that they're so worried about having so many job vacancies and so many companies and so many businesses trying to hire people right now, and that is a wage price spiral. Now, you might think, okay, well, if it's a bad thing, that means that wages are going down, but no, it's the opposite. Wage price spiral in this context is referring to wage prices going up dramatically. When we have so much demand in the economy, businesses need to hire more people. Now, we don't have enough people to fit into those jobs right now, so the Bank of Canada is worried that these businesses are going to increase their rates, increase the hourly rate that each individual that they hire is getting paid to try to entice them to come work for them. And you might be saying right now, well, Russell, prices are going up. I should get paid a little bit more. And I tend to agree with you right there. The cost of living is going up. People deserve to get paid more. But the Bank of Canada is looking at this from a different angle, saying that, hey, if wage prices go up, we're going to see even worse inflation. Take a look at this. You'll remember we talked about the importance of inflation expectations, what you think is going to happen in the future when it comes to inflation. Now, this applies to you, but also to individual businesses, right? And the average employee. If everyone thinks that prices are going up in the future, then everyone's going to demand higher wages and need to pay higher wages to get people to come work for them. The Bank of Canada thinks that this increases the risk that a self-reinforcing wage price spiral could ensue, a key upside risk to the inflation outlook. So they're saying that inflation could get even worse if people start getting paid more, right? If the average employee gets paid more, then they have the more money to spend on more goods, which could cause the price of those goods to go up even further, which then means that businesses need to pay people more so that they can afford goods and so that they'll come work with them. And you can sort of see how this spiral that the Bank of Canada is worried about could potentially play out. So the Bank of Canada is essentially saying we would rather keep wages low if at all possible. We want to crush asset and investment prices, increase the amount that people have to pay to borrow money, maybe for their mortgages or their credit cards, and make everyone feel so poor that they hoard all their money and don't go out and spend it. They just start saving. Now, when people stop spending their money, well, maybe that'll solve our inflation problem because there's not as much demand and the same amount of supply, and maybe things could start to even out. That's what the Bank of Canada thinks, at least. But this will certainly hurt Canadians in the short term. With a high cost of living due to inflation and a high cost of borrowing due to these interest rate hikes, well, that is going to pinch Canadians' pocketbooks pretty tightly, and Tiff recognizes this and even says it himself. Let's listen in.
Higher interest rates will affect Canadians who are already feeling the pain of high inflation. It can seem counterintuitive to add to the interest costs Canadians face in order to combat the cost of inflation. But by increasing the cost of borrowing, we will moderate spending and return inflation to its target. We need to get price changes back to normal. This matters because it gives people predictability to plan their spending and saving decisions, to budget, and to live their lives without having to worry about what prices are going to be next week, next month, or next year. The best way to protect people from high inflation is to eliminate it. That's our job, and we're determined to do it. The Governing Council is resolute in its commitment to price stability.
He says very definitively that is our goal. We want to keep inflation around the 2 to 3% range. That is actually the Bank of Canada's mandate, to keep inflation between 1% and 3%, and they're going to do anything they can to do that. So what they're saying right now is that, hey, we need to take these drastic steps, increase interest rates so dramatically now to stop us from having to do it even more dramatically in the future. If if we saw a wage price spiral, well, we would get even farther away from that 1 to 3% inflation target, and we'd have to be even more drastic and even more volatile in the way that that affects markets and affects the economy, and could actually cause financial instability. So they're saying this is going to suck for the average Canadian in the short term. Mortgage rates are going to be high, people are going to be pinched, and it's also the best case scenario as well, because if things were to get worse, we'd have to do this even more drastically. People would have to deal with that. Now, this response could also have something to do with the US CPI rate, or the inflation rate that just came out today. And we often look at this as an indicator of what's going to happen in Canada. They say US inflation has quickened to 9.1%, amping up the Fed pressure to go big. The Fed hasn't made a 1% increase rate. That's the US sort of Bank of Canada counterpart. So the Bank of Canada could be trying to get ahead of this even more. But whether or not this is going to work and lead into a soft landing, or if it's going to lead into a recession, well, that remains to be seen. But with that said, I'm curious what you think about all this. Do you think the Bank of Canada is doing this at the right time, or maybe did they miss the boat? Should they have started raising interest rates maybe 6 months ago instead of 3 months ago, so we could be ahead of the game here and not seeing this skyrocketing inflation? Or do you think they should have taken a different route altogether, or maybe you think the system entirely is doomed to fail? Let me know down in the comments what you think. It's a complex situation. I want to hear from you. But with that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.